Hello and welcome to this IFA Product Spotlight. I'm Keith Ford, the Deputy Editor of IFA, and I'm joined today by Steve Bennett, who is the Direct CEO of Charter Hall. Welcome, Steve.
Thanks, Keith, for having me.
Well, it's great to have you here. We're going to be talking about, core real estate, essentially, and why it is a bit of an attractive asset class. Can you give us a little bit of a rundown on Charter Hall and what you guys do, particularly within the direct business that you're the CEO of?
Yeah, look, the first thing I'd say is many people aren't aware that Charter Hall is the largest owner of real estate in Australia. We've got more than 1,600 assets across all the core real estate sectors and around $70 billion of funds under management. That gives us a great level of information, data and analysis and insight into structural and cyclical trends that are playing out. The part of the business that I look after aims to simply provide advisors, high net wealth clients, family offices, access to the same institutional quality assets and funds that Charter Hall does to super funds, sovereign wealth funds, pension capital, but lower the entry point. So not impacting the quality, but making it more accessible for that part of the market.
So looking at core real estate as an asset class at the moment, what within current market conditions are we seeing that's making it so attractive?
Yeah, look, before I talk about the go forward, I think it's required that I talk about what's happened the last few years. And it has been a tough period.
Yeah.
Following the fastest level of interest rate increases in a generation, we've seen valuations come off somewhere between 15 and 30% across the board, depending on the individual sector. Pleasingly though, what we've seen is a stabilisation in valuations. We've already seen industrial and convenience retail, such as Bunnings, servos, pubs, bottom out. We're still expecting office to be at or very near the bottom. But I'm seeing forward-looking equity IRRs for core real estate, so without taking on any material development or repositioning risk, as good as I've seen in my career. So that's probably where we stand at this point in the cycle. Tough couple of past years, but the forward-looking horizon looks fabulous for investors.
Right, so if you're looking at prime office assets, which, trying to get it into that direct market, when you're looking at those in conviction markets, how are they expected to outperform?
Yeah, I think the key word there is conviction markets. So just like when you're looking at an equity, you can't just buy one equity stock and think it's all the same. The same applies in office markets. We think that core, well-located Sydney and Brisbane office assets will do extremely well. And that's a function of structural tailwinds. So we've seen large population growth. That's great for office use. We're seeing strong economic growth. And importantly, the supply side of things continues to fall off. One of the downsides of what we've seen in recent years is that construction costs are elevated. It's hard to get skilled workers. Planning approvals are slow. And what it means is that the forward-looking supply pipeline over the next 5 years, we expect will be somewhere around 35% less than the prior 5 years. And the simple maths is that it isn't economic to build new office buildings in most locations. So as an existing landlord with a $2 billion portfolio in one of our largest office funds, we think that will drive rental growth and ultimately valuation growth for investors in that fund.
Right, and there's also probably a bit of a slowdown in demand, which has caused those kind of falls in previous years. So then those large projects, maybe building those offices, haven't been taking place. You guys now having a large holding currently, able to catch that upswing as demand for returning to offices and more population growth kind of picks it up on that side.
Yeah, look, I think that's an important thing. Like internally, we've stopped talking about return to the office and working from home. We're done on that. We've reached a level where the companies that didn't have flexibility have done so. We're now having more discussions with the large institutional and government tenants on not just maintaining their footprint, but in many cases taking more space because they realise that they've given up too much. And if you want people back even 3 or 4 days a week, you typically want them back on the same days. So I question how much space saving there is. So that trend is well and truly moved on. But when people do want to take space, they want the best quality real estate. So if you want your team to be collaborative, productive, You want to be in a well-located asset. We were talking before about getting here from the metro. This is a well-located asset, the Charter Hall office in Martin Place, walking distance to everything. They're the type of locations people want to be in, and those assets will receive more inbound tenant demand, which ultimately flows through to higher rental growth. And as I said, the valuations then ultimately follow cash flows.
That's right, 7 minutes on the metro from Martin Place to North Sydney.
There you go, very quick.
Looking at the way that interest rates have acted over the last little period, obviously we've gotten our first cut, as you mentioned before, but how have those rising interest rates impacted office valuations, and why might now be an opportune time to start investing in those high quality assets?
Yeah, so the first thing to note, the valuation downturn, so peak valuations across most commercial real estate sectors were June 2022. The increase in interest rates from that point repriced people's risks and required hurdle rates, and that was the single biggest driver that led to valuations coming off. So even if interest rates don't move down again from this point, the fact we've hit peak and we've already had one cut, we think is going to be very supportive of valuations. So the way it works, capitalisation rates have stopped increasing. Then from this point, you tend to get valuations move in line with rental growth. And then most commentators are forecasting 75 to 100 basis points of interest rate cuts. We think if that happens, you'll get really turbocharged returns on the valuation side as well. But not a tomorrow. Real estate should be thought of as a medium-term investment, typically a 5-year investment horizon, stable cash flows, low correlation to other assets. And to your point at the start of that question, this is the point in the cycle where you can get an 8% distribution yield from a core office fund and equity IRRs around that 13% plus, which is something that doesn't come along very often for core real estate in this country.
Yeah, and if interest rates are expected to continue coming down, as you mentioned, 75 to 100 basis points is pretty much in line with what most people are calling, most economists, over until, maybe mid next year, things along those lines. Would that make it a more attractive proposition to get in now before that starts happening and prices start going up in response to that? Is that something that you're seeing?
Yeah, look, I never want to rush investors. I think if, regardless of the asset class, do your research, you decide the point in time that suits you. Having said that, we are seeing the big institutional investors begin to move first. Typically, it's what happens. They're looking, and they are long-term investors saying, well, even heaven forbid I'm not picking the very bottom of the cycle, I'm so close it doesn't matter.
Right.
And as I said, if you can pull out a strong income yield and that capital growth that will come through over time, the risk-adjusted returns are looking fabulous. So regardless of whether we have further interest rate cuts or not, we are very positive around the valuation side of the equation over that next 3 to 5 year period.
Good to not be aiming completely on what the RBA does, always a good idea. You mentioned a little bit earlier around the stabilisation of cap rates. What does that indicate about changing investor sentiment?
Look, I think people are re-weighting back into real estate. When there was more uncertainty on where peak interest rates would be, people would just sit on the sidelines. Transaction volumes across all the core real estate sectors of office, industrial and retail were subdued. We're now seeing a rebound in the transaction volume in the physical markets. And that's typically one of the precursors to getting valuation growth. So all the signs are pointing in the right direction. The population growth we're seeing in this country, Australia's forecast to have the second highest population growth over the next 5 years in the developed world. And regardless of your view on whether that's good or bad, I can only look at it from a real estate point of view, and as a major landlord with 1,600 assets across all the core sectors, that will be a positive net demand for all real estate sectors, including office. And as I said, the supply side is not keeping up with the demand side of the equation.
Yeah, it's a good point there around whether or not that's an outcome you want or don't want. You're dealing with the reality as it is versus what you hope might happen down the track. It's on what is actually happening.
And that's an important point. We try and look through some of the noise, the short-term noise particularly, and look at the long-term trends and the markets which we think will outperform. Interestingly, there's been a lot of noise recently with what's happening in America, tariffs and so on. We are having more conversations with the institutional capital from offshore saying Australia's always screened fantastically well. It's a stable economy, great rule of law, transparent, low corruption, great growth from an economic side of view and the people side of view. We do expect that there may be a reassessment on how much people want to allocate into Asia Pacific. And Australia will get a large proportion of that in the commercial real estate side. So these are very rational investors. They can put their money anywhere in the world. And it's interesting that they've started to buy back into the physical markets. And it's one of the reasons why we are very confident around the Australian office market going forward.
So you've touched on that a little bit here, what I was going to ask you next, which is around what the emerging trends are that you're seeing, particularly in Australian commercial real estate at the moment. Obviously, that's one of those. What else are you seeing?
Supply will continue to be challenged. I'll give you an example. We've got an asset in the direct office fund. To build it would cost you 35% more than the December book value, which is also based on an independent value. We've got another one up in Brisbane that's going to cost you 40% more to build it. So if you had a $100 million asset on your books, it's going to cost you $140 million in that example to build the same thing. So why would I take on development risk, leasing risk, financing risk, planning risk, when I can go out in the physical market and buy an equivalent much cheaper? Well, the answer is people aren't going to build it. So we think that supply side is going to play out over time. And people don't realise, if you want to build an office building in one of the CBDs in Australia, you're looking at 4 to 6 years from the time you buy it to getting through all those hurdles. So things that aren't being built now, they're not coming online to 2030 plus. So we are looking at that longer term trend. As I said, the work from home trend, we think that's played itself out. We are expecting that net absorption, which is just an industry term for net tenant demand, to continue to be favourable. But we do think if you have secondary lower quality stock, you're likely to miss out on this tenant demand, because the big institutional tenants and government tenants, which at Charter Hall we're targeting, they want strong environmental ratings, they want well-located assets, great natural light, efficient floor plates, and they're not going to get those from secondary assets.
And it's an interesting, it's kind of an interesting area that you mentioned with the how long it takes to build and the amount of cost involved in building, where you end up with an asset that's worth the same amount as one that's already built, and you are taking on all those extra risks. Is there anything else in there that would maybe push people towards the building, or do you really see it, a lot of it, just there's not much point for people going that route?
So the biggest thing that will get new supply moving is that the rents need to increase materially. So there's what's called an economic rent that will justify a certain amount of construction costs and make your feasibility work. So let's just say you need $1,000 a metre rent in Sydney CBD to get a development out of the ground. That's not the actual numbers, but just for illustrative purposes. If market rents are only $800 in the market, that probably isn't going to get built because tenants won't necessarily pay that. But what tends to happen is that you'll see the existing stock, the rents continue to climb, and valuations of property aren't that complicated. If the cash flows through higher rental values are going up, all else being equal, the valuations go up. So in that case, 200 on 800, that's a 25% increase in the valuation for that asset. And at that $1,000 mark, then you will start to see that new supply begin to come onto the market. Right.
And so Charter Hall, as you said, very big holder of real estate and commercial real estate in Australia. You had mentioned to me around the Charter Hall Direct Office Fund. Can you give me a bit of a rundown on how that works, and is that part of the real push to get these opportunities into the kind of direct market?
Yeah, look, that fund is very diversified. It's, as at December, had a portfolio, 14 assets, $2 billion, distribution yield, 8% to investors, paid quarterly. So strong level of income. We think it's very realistic to get low double-digit total returns off that, largely because of the tenants and the buildings we've got. But equally, for those advisors or investors who are looking at commercial real estate, it's a great entry point. Similar to how you hear buy the dip in equities markets, why wouldn't you rather invest into commercial real estate after valuations have come off and to put it in context, valuations for office property have fallen as far and in many markets more than they did in the GFC.
Right.
That's something people don't necessarily realise because the GFC was very short and sharp, what happened. What you've had here is 2.5 years of valuation declines, and we've already seen in most of the sectors valuations begin to trend up. So we think that is a very positive sign.
And as you mentioned, a little bit earlier, with some of the volatility from tariff announcements and things along those lines, there has been some shocks within equity markets. So potentially moving some of your portfolio into something that's maybe a little more stable, you might not get the same rapid swings. That might be an attractive option for some investors.
And it is. And we have many of the top Barron's advisors invested across the Charter Hall platform. So they're very sophisticated advisors. They know what they're doing. They have sophisticated portfolio construction. And what they tend to do is they put commercial real estate, like the direct office fund, in the unlisted part or illiquid part of the client portfolio. It generates that regular income, so that 8% in this case per annum. But they also know that they don't necessarily want to touch it for a couple of years. And it does have low correlation to Aussie equities, global equities. So what you tend to see is you might have a bit of volatility in the public markets, and the unlisted funds will keep on ticking through, lowering that overall portfolio risk for the client as well.
Awesome. Well, thank you very much for joining me today, Steve. It was great to have a chat.
Thanks, Keith. Pleasure.
And thank you to everyone for watching along. Hopefully you enjoyed what you heard from Steve from Charter Hall.